My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to ConAgra. Other people want to make friends. I'm just trying to save you a little money. My job, not just entertain, but put days like today in context because I know how hard they are. Call me. 1-800-743-CNBC. Tweet me, Jim Cramer. Look, we're taught always to look forward because bringing up the past is supposed to be worthless. That's the first lesson in business wherever you go. And you know what? It's wrong. Sometimes the past is so crazy, so nuts that it distorts everything. And that's what's happened with COVID, which disrupted so many things to the point where it's still with us, even though the pandemic ended more than 2 years ago. It's just not acknowledged enough as a factor still. And I got to start changing that so we can start making some money because of it. Oh, sure, the markets were humming for most of the day until oil broke to the upside despite ample supply, causing people to believe that something terrible must be lurking in the Middle East. Bonds rallied, rates fell. That's called a flight to quality ahead of what many traders think will be a widening of both the Ukraine and Mideast wars. Then Fed official Neil Kashkari spoke up, don't they all, and said maybe we don't need any rate cuts. Perfect. Thanks, pal. Can't you just let Jay Powell do the talking? Wouldn't that help? But the 1-2 punch knocked the Dow off 530 points. S&P plunged 1.23%. NASDAQ plummeted 1.40%. We've been saying that this market's overbought. It's finally no longer. But the action's not good. See, the nasty, albeit ephemeral daily action does control our thinking. But the deeper text of this market, the context, often revolves around the last war of COVID and how hard it is to figure out which habits are dead and which ones are still around. Take tonight, where we're going to be speaking to ConAgra. See, this was the #1 performer in the S&P 500. This is why I'm talking about this stuff. The #1 in a bad day, the packaged food company ConAgra dominates the frozen food aisle. Before the pandemic, ConAgra's frozen healthy choice bowls were crushing it. Millennials, Gen Z, singles, they thronged these fast and inexpensive dishes, making ConAgra one of the hottest stocks in the group. But then came the pandemic. When COVID struck, it drove up prices for pretty much everything, right? At the supermarket, how much you saw how much it cost, especially things that had to be packaged or transported in a special way, like frozen foods. Next thing you know, because of the pandemic, ConAgra needs to raise the price of its products to you by 30%. You go from having a cheap product that's loved 7 days a week to a relatively expensive product that's liked only 5 days a week. And the other 2 days you cook from scratch. You make burgers, chicken, whatever. You save some money. But that was then, and suddenly this is now. As Sean Conley, the ConAgra CEO, will explain to us later tonight, the healthy choice consumer has now gotten sick of cooking. More important, sick of cleaning. So they're now buying healthy choice meals 7 days a week. Yet this frozen food aisle is buzzing again, and almost nobody save ConAgra saw it coming. Given the profile of so much of ConAgra's product line, I bet this won't just be a one-quarter phenomenon. If anything, it's the first quarter where the consumer's back, the first one where the collective cooking and cleaning got the people, and they're in now at last buying ConAgra goods like the old days when the stock was much higher. I think it's going to stay this way for some time if you don't follow the history of the pandemic. You miss stocks like ConAgra, again, the #1 performer on a really ugly day. I bring this up because we can't afford to take these COVID-related changes for granted. For example, here's two companies that have been crushed by this, United Health Group and Humana. They were terrific stocks for ages, but now they are just being obliterated. What's wrong? First, there were millions of people who put off non-urgent surgery until COVID died down and they felt safe going to the hospital. That allowed the health insurers to make out like bandits during the pandemic, but when they didn't have to pay for this stuff. But now, and of course they got your premiums, but now people are finally getting these procedures, and it's causing shortfalls everywhere. Shortfall after shortfall for UNH and Humana. Then to add insult to injury, the managed care companies try to recoup some of these new expenses by raising prices for Medicare Advantage policies. They need to get government approval to do that, though, because it really impacts retirees. This time, they didn't get approval. The requests for larger increases were denied. So the stocks got hit again. Sell, 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 sell. See, that's all about COVID. And again, almost no one saw it coming. Because even though they should have been pretty obvious, that's how the stocks of United Health and Humana, again, huge favorites of this market for so long, are now down 13.5% and 32% respectively this year alone. How about the stock of Disney? David Faber interviewed CEO Bob Iger this morning after his win in the proxy fight with Trian, the investment vehicle for Nelson Peltz. Midway through the interview, Bob talked about his predecessor. No need to name him since nobody at Disney seems to be willing to. Oh, okay, I'll do it anyway. Bob Chapek. And how he was running the company during the worst possible moment, where theme parks were empty, movie theaters were closed. The stock took it on the chin, of course, and didn't really recover until the last few months. I think we misjudged how much Disney was really hurt, first by COVID and then by management's response to COVID. Frantic attempts to meet their streaming goals, not backed up by what had been the company's regular cash flow. Now there's no excuse, which is a big reason why Nelson Peltz thought it was worth going after some board seats. But things got better as Peltz agitated while the pandemic faded and the travel tailwinds reemerged. I don't think Peltz saw the turnaround in the stock coming, even as he arguably caused a lot of it, which ironically then hurt his chances of joining the board. Now, have you noticed, for instance, that the cruise line stocks have been among the best performers for the last 18 months, especially Royal Caribbean? Seems quizzical, but wait a second. This move's almost entirely a function of COVID and its after effects. First, cruise ships were all at the epicenter of the pandemic, and the publicity was horrendous. When short sellers bet against these stocks, they thought they were shooting fish in a barrel. If you go back and look at the bottom of the COVID bear market, you'll see some onerous refinancings for Carnival, representing real bankruptcy risk. At the same time, the cruise CEOs were telling you not to worry as the months wore on, because customers always come back to cruising. Too great a bargain for them to ignore. Oh, the hedge funds didn't believe that, though. They shorted the cruise line stocks endlessly and mercilessly. But it turned out that the CEOs were right. The customers did come back. And then the shorts were overrun. So what happens? Royal Caribbean goes from $37 when the pandemic truly began to ebb near the end of 2022 to $135 now. That's the short sellers covering because of the broken COVID trade. Many people who tried to game habits lost fortunes. They thought there was no way Pelton was going to lose all those subscribers, right? Oops, wrong. Who knows if this one will ever come back? They know nothing! Williams-Sonoma had been the place during the pandemic to buy outdoor furniture. Remember, we used to go outside because we were afraid of giving it to each other? Or goods to handle the home office because we had to do that because we weren't going to the office anymore. Oh, then we got all the outdoor furniture we needed and we went back to work. Next thing you know, the stock gets cut in half. Then crazily, we needed new stuff again. We went back to Williams-Sonoma, this time helped by some new seasonal hits because Laura Albert's so good. She's the CEO. And then the stock doubles right back. And then it almost triples. The worst post-COVID hangover is personal computers. First, the work-from-home era became the dominant narrative. Then the world went back to normal, and people shorted Dell or HP like crazy. No let up. But then finally, Dell turned out to have a tie-in with generative AI. It was NVIDIA's preferred partner to connect companies to NVIDIA's supercomputers. Remember NVIDIA? That stock gets hurt every day. Next thing you know, there's a short squeeze into the stock of Dell, although HP, without a huge NVIDIA tie-in, kind of does nothing. We still can't get our arms around who's coming back to work and who isn't. Do we need that commercial real estate or not? Again, that's post-COVID lack of knowledge. So many stocks are controlled by their past, and right now their pasts are still controlled by COVID. Sure, right now we're in the grips of higher oil and what that means for inflation. But the bottom line, I got to tell you, if you want to understand this economy, it's all about knowing what happened in the past and then looking for ways to extrapolate it to the future. The pandemic may be over, but we are just now finding out how our habits have changed, some permanently and some in retrospect, not at all. Robert in New York. Robert!
Jim! Robert. Jim, I have my Cramer ringtones on my phone to remind me how much money you made me and how much money you saved me.
Oh, man, you're a good guy.
But Jim, I love you. You saved me. You gave us this whole scenario to take some money off the table. Again, you did it for me, and you've done it for me multiple times.
Thank you. Thank you. I got to tell you, you do it. Like I'm watching with Jeff Marks, watching Mark go down. I said, Jeff, I did say repeatedly, take money off the table. It always hurts. But we got it right. And, Robert, I'm so glad you pointed it out because, it does get me down a little, but you just reinvigorated myself and made me feel like I am ready for your question so I can hit it out of the park. Let me help you.
Jim, you reinvigorate me because I look at my portfolio, and on the downclines, it never goes down because I listen to you.
It probably goes down a little. I want to just go down less, but thank you. You're a good man. How can I help?
Okay, Jim, let's talk about a stock that's up 11% in 1 month. The stock could hit a $500 billion market cap this year. And the energy sector has been on a tear, crushing the S&P against last month, okay? Not to mention they're getting into the alternative energy space. And with oil up above $80 a barrel, this is a dream for this company. They posted sales and earnings nearly 10-year highs, a 13.1 operating margin, and $33.5 billion in free cash flow, and they returned $32.4 billion to shareholders. ExxonMobil.
You know, it's funny, Robert. I saw the stock up on a bad day, even though they admitted last night that they missed the numbers pretty big. What does that tell you about what can happen here? Now, it is at a high. We don't buy at a high. We wait for a 3 to 5 to 7% pullback. We buy at those levels. But you are a winner, and you've recommended a winner, and I thank you for your kind thoughts because, yes, we told people to lighten up. You remembered. Thank you. If you want to get a handle on this economy, then you need to understand what happened during the pandemic and how that's impacting companies right now. Even though we've all forgotten the pandemic, we got to bring it back, if only just to remember in our minds what to do. Mad Money tonight. ConAgra turned in a solid quarter this morning. We sent the stock higher. So what can we glean about the state of the consumer spending from the packaged food giant report after the pandemic? I'm digging the numbers of this year. Then last night I covered how I think small caps could be due from a move higher. Tonight I'm going to take a closer look at some small cap industrials and share the names with you, even though I know most of them went down today. We can't turn off our minds because the market went down. And late last year, I shared my power rankings in the media space, and 5 months later, well, the rankings have held up pretty well. But now that the Disney proxy battle is over, and we've been talking to members of the investing club about that, what do we do here? Do we update the rankings? Of course we do. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.